allowance methods. So you have the direct method, which is non-GAAP, and then you have allowance methods, which are GAAP. Yay! That deserves a happy face. These are the ways you need to know it. The first way is called the percent or percentage of sales method. This is the one you need to know how to do in more detail. The percent of sales method is, of course, GAAP. The other one, I'm going to not leave as much room because I'm not going to show you how to do it, because you really need to know how to do the first one. The second one, you just need to understand the concept. It is called the aging of receivables method. All right. They also have other names by which they are called. The percent of sales method is also called the income statement method. Well, if that one's called the income statement method, it's a pretty good guess that this one is called the balance sheet method. Now, it's pretty easy to figure out which one would be which. Sales goes on the income statement, and over here, receivables go on the balance sheet. So it kind of makes sense of how they do this. But let me just draw a line to partition this out of there, because I'm not going to show you how to do that. I'll just explain it in a bit. But you do need to know how to do the percentage of sales method. Essentially, we do follow the matching principle here, which means when we book the revenue, we will book the expense at the same time based on an estimate. So here we have our accounts receivable here, and once again we have $4,000 sitting in there. And at the same time that we book the receivable, we'll book the sales revenue. We just earned $4,000. But under this percent of sales or income statement method, we have to book the expense at the same time that we book the revenue. Well, this involves a contra account. Remember the accumulated depreciation account, which was a contra account for our long-term assets? This is sort of the same thing. Accounts receivable has a contra account that is the allowance. This contra account could be called the allowance for bad debts, or the allowance for uncollectible accounts, or the allowance for doubtful accounts. I'm going to use uncollectible accounts, often because that's what a lot of the textbooks use. The allowance for uncollectible accounts. And also, I'm going to make an uncollectible account expense. There. So what happens is, as soon as we booked that $4,000 in accounts receivable there into the revenue, we must book what percent of those sales we don't think we're going to be able to collect. So let's say the amount we don't think we're going to collect, and this will be based on a historical norm. We look back over the years, and generally we can't collect 4%. Well, 4% of $4,000 is $160, I think. Yes. So, at the same time that we put that $4,000 in there, we are going to put a contra account of 4% under the allowance, and we will expense it right away as well. Very interesting. What that gives us is called a net realizable value of those accounts receivable, NRV. the NRV of our accounts receivable is the net of $4,000 minus the $160 in the allowance. So, how much is that? That is $38.40, and it really doesn't show down at the bottom of my screen. So our net realizable value of our accounts receivable is only $38.40. That is the real value. And remember at the beginning I said financial statements show the value of your company? Well, our asset is not really worth $4,000. It's worth $38.40. And that's why we do the allowance method right up front. It's an estimate. So step one is essentially going to have 4 steps. We're going to debit the account receivable, $4,000 in the journal entry, and credit sales revenue for the same $4,000. Then right away, we're going to debit uncollectible account expense for $160 and credit the allowance for doubtful account or uncollectible accounts for the same $160. So now, at this point, what happens when we actually are unable to collect? It's 6 months later, and we cannot collect on that money. What are we going to do? We've already expensed $160. Well, let's say we were able to collect some of it, or we haven't given up on it, but $100 we know we're never going to be able to collect. We're certain now. It's not an estimate. Well, that brings us to step 2. At step 2, we have to write it off, but we've already written it to expense. So what do? Step 2, we take, let's say it's just $100, we take it out of accounts receivable and out of the allowance. That's it. So we debit the allowance for uncollectible accounts for $100, and we credit accounts receivable. It has no impact whatsoever on the income statement. There were no sales revenue or expense accounts affected. We just backed it out. Under the allowance methods, it's reported to revenue and expense right away, and we never touch that again. All right, so now, step 3. We've given up on collecting that $100, but what if they come back and they pay it? Oh, man. Well, we have to undo step 2. We just reverse it. So now we are going to debit accounts receivable for that $100, credit the allowance for uncollectible accounts, that $100. So we've just undone that write-off, and now we collected cash, didn't we? So we have to record that we collected the cash. We now have $100 of cash, so I don't think there's room here, but I'm going to squeeze it down below. Debit cash, 100, and what are we going to credit? Accounts receivable. We had just put it back into our accounts receivable. Now we take it back out. 100. Accounts receivable for 100. Can't really see that. It's too low at the bottom of my screen. But that is how, 1, we book the revenue and the expense at the same time in step 1. Step 2 is when we give up on collecting it and we take it out of accounts receivable and the allowance. And step 3 is, what if we recover some money that we didn't expect to? Step 3 is recovery of that, where we collect the cash and take it out of accounts receivable. So that's how you do the percent of sales method.